Welcome to the Business of Property podcast. I'm Simon.
I'm Stuart.
We're both property people running our own businesses. This podcast is just us chatting, as we often do, about anything and everything property. This week, we are going to talk a bit more about the property market and the fact that it seems to be going a little bit crazy at the moment. We talked a bit about this a couple of episodes ago, I think. We'll put the appropriate link in the show notes. There are, as ever, more and more reports coming out as time goes on, looking at newer and newer market statistics. And there are 3 property price reports that we're going to look at today from properties that are for sale and another one for rental. So we've got Nationwide, Halifax, e.surv are the 3 talking about for sale properties. And then we've also got a Hamptons rental index one, obviously talking about rental properties. Then we've had a request in from Chris, who's at Art of Property on Twitter, to ask our thoughts in the longer term. He's suggested 5 years. I'm not sure we're going to get that far, but maybe we'll speculate a little bit beyond what we have before, which is sort of a few months to a year, maybe.
Yeah, I'll have to tell Chris I don't usually go past next week.
No, indeed. I'm with you there. It's looking out 5 years is, I think, extremely ambitious in the current market. Even in a sort of stable, relatively predictable world, I think trying to look out 5 years is difficult. But yeah, in the current world where so much is up in the air and so much is unknown, as you say, about next month and certainly the next 6 months, never mind the next 5 years, I think, yes, I think we'll be doing little more than wild speculation. But then again, I think that's what anybody does when they're looking at that far away, really.
Yeah, and I also think, to what end we're doing it for? What is it that we want?
That's a very good question, yeah. If you knew what the property market was going to do for the next 5 years, what effect would that have on your behaviour? If you knew that prices were going to decrease by 3% a year for the next 5 years, what would you do? Would you stop buying property for investment? Or would you just sort of recalibrate your objectives onto ROI or yield sort of targets?
Would you invest in property at all?
Oh, yes. Well, there's a good question. But then if the property market's going down, is the world economy generally going down? So yeah, perhaps you could say property market's going down, but then stocks and shares and things are going up. So obviously you invest in something different. But if the whole world economy is going down together, then is property any worse? Maybe you should still stick with property. At least you're getting ROI if you invest sensibly.
And I think that is why I asked a flippant question around to what end. A slightly flippant question, because for me, we're going to invest in property. I think people ask that question typically because they're thinking about areas. Would be my assumption is that when we say what do we think is going to happen in the next year, 3 years, 5 years, is because a lot of people are thinking about, well, I'm looking at buying sometimes very specifically Manchester, Liverpool, or less specifically Northwest, Southwest, and so on, and thinking about where might we see the biggest growth. And you've already said it, there are so many factors, macro and micro. So macro as in pandemics, micro as in there's going to be a new shopping centre built around the corner from where you've just bought. So that's why I'm always very sort of hesitant around these things. And I think you and I have discussed it before. I when I get messages into my LinkedIn message box or email box, it's usually, I'd like to buy in town, put name here. What do you think? And it's always, for me, it's always, well, what do you think? You know, what research have you done, and so on. And if we're thinking next 5 years, bringing this back around to what you said, I think, well, actually, if I think I'm going to invest in property as opposed to stocks and shares or, you know, equity investing, whatever it might be, then if we thought property was going to decrease, then what would that mean to other areas of the economy? Because we've seen that property is a big driver of the rest of the economy.
Yep, quite. If you're trying to choose your area of investment based on which areas you think are going to go up or down, then presumably you're investing for capital growth in those areas. But I think really in such an unstable market as we're expecting things to be at the moment, not necessarily bad because it may well be going up, but it's just unstable because it's unpredictable. We can't reliably say what's going to happen. I think trying to guess the market and invest for capital growth is probably not the best approach. I think you're much better off trying to focus more on yield and ROI and those sorts of figures, which are, I think, are good things to target anyway, but especially at the moment.
Yeah, we mentioned that recently, didn't we? Is focus on the financials of what you're looking at in the round, as in, is the property I'm looking at, do I think it could cash flow? Will it yield what I want it to yield? Will it provide the ROI I want it to provide? And if that is stacking up for you personally, based on your own metrics, then that gives you a really positive feeling to go on and then maybe think about the rest. So I think, Chris, if you can tweet us again on the business of property, let us know what you're thinking about, and maybe we can have a more detailed conversation around those elements. But bringing us onto the subject of the day, because we were talking about house prices, I'm going to quote from some of the research Simon pulled out, which is from Robert Gardner, who's Nationwide's chief economist. So I'm guessing he's paid a few quid to think about things such as the future and the future of the economy. And
that doesn't mean he's going to be any more reliable in his predictions just because he's paid more for them.
but I'm just going to say, so I feel quite comfortable that I'm in good company, because I'm just going to quote one line. He says, "The longer term outlook remains highly uncertain." So that's just one sentence from the research that you have done and we've looked at. That one sentence sums it up for me, and that's someone that I would imagine spends a large part of his working day looking into the detail of that. And if he's saying that's uncertain, then I feel quite comfortable sitting next to him and saying, yeah, maybe we shouldn't project.
Yeah, I mean, that's just got to be the theme, hasn't it? I mean, if we look back 6 months, we were talking about down valuations, and we had Emma join us for an episode, and she was talking about her clients having to have trouble getting mortgages because the down valuation is coming through, and then having to go back to the sellers and say, actually, can we reduce the price we're going to pay for this property because we can't get the mortgage at the actual agreed sale price or purchase price. And now, 6 months later, we're looking at reports that say there's been I'll quote the actual numbers, 5.7% year on year increase from Nationwide, that's seasonally adjusted. Halifax, 6.5% year on year, although theirs is not seasonally adjusted, just to make comparison easier. And then e.surv, the most optimistic, at 9.8% year on year increase. I mean, there's absolutely crazy increases in a year. And these are comparisons from March. So March 2020, things hadn't started being locked down particularly at that, to influence those stats. Things hadn't slowed down or prices changed or anything at that point. So it's not that these year-on-year figures are particularly distorted because of the pandemic. They are comparing sensible pre-pandemic prices with what we've got now. And we're seeing these massive increases, which, yeah, I don't think anyone foresaw 6 months ago. Certainly with all the banks being very, very pessimistic about it and putting in down valuations.
I think when you look at the annual percentage change, and if we can snapshot that, for example, and we'll put it in the notes or on the businessofproperty.com, what staggers me, so you've just talked about the 5.7% annual increase. You go back to last March, that was a 3% increase. So we can just assume that what was going to happen had happened in March before lockdown. The March prior to that, the increase was 0.7. And when you look down at the annual increases, it's it's staggering just how much of an impact from April onwards, when you look at it versus the prior year, even month on month, from the year 2019, most annual increases were 0 point something, and obviously as we move into 2020, we know that we've got the support and everything else that we've talked about in terms of stamp duty relief. But the fact that now in 21, we're now seeing, from December, 7.3, 6.4, I think we used the word on previous podcasts, but for me personally, it's staggering just how much the property market is increasing right now.
Yeah, I can't remember which of these reports it has it in, but one of them, I think, had a graph going back, 10, 15, 20 years, whatever it was, of percentage year-on-year increases, obviously over that time period. And yeah, you can see there's a big dip around the crash in 2007, 2008, and then a bit of a recovery, and then it drops down. And yeah, as you say, then for a few years, house prices were almost flat. Those small increases, but almost flat. And yes, then it's a big uptick in the last couple of years, effectively. And I don't think anyone really expected it to be such a big uptick. Even people who weren't being pessimistic about the pandemic effect still weren't being quite as optimistic as reality has turned out to be. So it's quite remarkable. And if we look at the Hamptons rental index, something that I think this particularly pulls out, I mean, the sale prices have similar sort of effects to an extent, but the rental one is really marked, is how it varies by area and region. So the overall figure from Hamptons is 4.4% increase year on year. But if you just look at inner London, they come out with a figure of 17.1% drop in rental prices. 17% drop in a year. That's a lot of money off a monthly rent. And that's sufficiently balanced by elsewhere that you end up with 4.4% overall. So outer London, 2.6% increase. So even just that little bit away from inner London is enough to see an increase. So that's a swing of some 19.5% or so from inner London losing money to outer London gaining or increasing in price. Then southeast, 7.8%, southwest, 9.1%. So you should be doing well there. Apparently 9.1% increase in rents in southwest. So yeah, it varies a lot. It's quite remarkable how different areas have had different effects.
Yeah, and obviously for London, particularly with rental, I know it from my own experience, but there is much more headroom to drop than there would be elsewhere. So, for example, I know a studio flat, and this is in Greater London, a studio flat, and people living elsewhere in the country will probably wince when they hear it, but a studio flat renting now, a 30-metre square studio flat renting for around £1,000, and that's reasonable. If you go into the centre of London, double that at least. So I can understand how that 17% happens, and then of course you've got the premium properties where people are living in, Kensington, Westminster areas. So to that, I can see how that happens.
Yeah, I'm afraid I don't remember the exact details of where it was, but I was really quite shocked when I saw a London-based room rental. So this is just a room in a shared house, over £1,000 a month. Wow, that's a lot of money just for a room. When I know in this area, you can not quite probably, but almost rent a 2-bed flat for that.
Well, I can trump that, because I was speaking with somebody in my investment area who was looking at a room. So he's got multiple children, and one of his kids goes to university in London. So we were talking about my rooms where we're looking between 120 to 140 for premium, very premium rooms. And he said, this is fine for me, because the other room I'm looking at for my other child was around £400 a week. So £1,600. And I think I'm under egging the pudding there, again, for a room in a house. So
My goodness. It's, enormous regional differences. Coming back to the house prices, again, regional differences. I've seen forum posts where people who have been talking again and again about how they invest up north, and they have a model where they pay 80,000 or thereabouts for a house and rent it out, consistently get 8% yield. They've now been saying that those same houses that a year ago they could buy for 80,000, they're now on the market for 125,000, having not seen any increase for years, basically since the crash in 2007 and 8. They've been consistently 80,000, and now, after a year of pandemic, obviously they've gone up to 125,000, and they're saying the rents have not gone up to match in that area, so they just can't get the yields. They can't continue their previous investment strategy in that area, just because the house price has gone up so much.
Yeah, not unleveraged, and that's a challenge. We see with the property we're selling and that's it. Because yes, it's great to get the capital growth, but if you're looking for other investors to buy, unless they're cash buyers, which of course they might be, but if they're not, then passing rental stress tests and whatever other levers the banks are going to have is going to get more and more difficult. So, that'll be an interesting one long term to see how that plays out, whether that changes. Because you've just made me think of the other chart we saw, and again, we'll try and share what we can, but it was just the house price to earnings ratio. And of course, when you go back 30 years, exactly 30 years to 1991, that was around 3.5. So price of a property about 3.5 times your earning, which was pretty much most of us of a certain age. That's what we have in our heads when we think about buying a house. That was always the number in my head. Oh, what can I get? Oh, it's 3.5 times. Well, since it looks around sort of 2012, it went up to 6 times between 2001 and 2006. Then, of course, we had the crash, the financial crash. But then since 2015, 2016, it hasn't got as high as it was pre-2008, but it's still, based on my rough estimations, around 6 times. So there's a real sort of long-term view about how this all plays out in terms of, the thing you'll talk about in pubs, in cafes, or wherever you talk about properties, like how long can this continue? And I imagine people have been having this conversation since 1991, but
yeah, right.
And we're still having it.
Yeah, I saw an article recently on Property Insider talking about exactly this, and it's very similar actually to the discussion we had a few episodes ago about when this ends, and indeed what ends it, as in the crazily increasing property market. Because there's got to be an end. There is going to be a limit reached at some point, probably, I would expect. And Property Insider listed a whole host of potential reasons that might keep that increase going, or indeed cause the end to it. And we talked about most of them before, but one that you were just talking about or tied into what you were just talking about, which we hadn't mentioned before, really was how cheap it is to borrow money at the moment. And I think that's got to have helped that earnings ratio go up again after the financial crash in 2007 and 8, because interest rates plummeted and borrowing money just got a lot cheaper. And for a while, it wasn't as easy to borrow money after the financial crash. It took a while for that to come back into play. And again, last year during the pandemic, the interest rates were still very low, but again, it got a bit harder to borrow money. It was more difficult to get mortgage companies to actually process the paperwork because they were struggling with staff. But also, mortgage companies withdrew products and reduced their maximum loan to values and got stricter on other checks that they had in place. And I think now they are easing those again, and the higher loan to value products are coming back onto the market and things. So just as the market is booming again, if you like, we have again the situation of cheap and easy money and borrowing being available. So I think while those continue, it will certainly be a help to fuel the market. But yeah, what it is that ends first to bring the market back down, I don't know. And there's so many possibilities that it could be. But yes, maybe it will be interest rates going up.
So hopefully, in a very long and detailed way, what we've said, Chris, is we don't know what the world's going to look like in 5 years' time.
Indeed. He did actually specifically mention house prices, buy-to-lets and holiday lets as things we might want to think about for our 5-year forecasts. And we've talked a lot about house prices. And I think the conclusion there is we don't know what's going to happen for the rest of this year, never mind 5 years. Buy-to-lets, I think they're pretty stable. I think they're in 5 years' time, there'll still be good demand for them. There'll still be a good, stable, consistent income available from buy-to-lets, single lets.
But as we've said, the yields may get tougher in certain areas depending on where you're looking.
Finance might get harder, especially with the rental cover requirements. And I think certain areas may change in sort of popularity. I think also certain property types may change in popularity. So, for example, gardens and open space are becoming a lot more important at the moment. Flats are becoming a bit less popular. But overall, people will still be living in flats. People will still be living in all property types. So I think they will, largely speaking, carry on. Holiday lets. Wow, what do you think there?
I was just about to say no thanks. Don't throw that hot potato over this side of the microphone.
Well, I'm sorry, I did.
Well, I can't. If we're looking at properties again, I think similar rules apply, don't they? In terms of looking at holiday lets, provided you're buying the right properties in the right area and you're getting the occupancy that you've worked out you need, whatever that is across the year of 75, 80% plus, then assuming those numbers worked for you when you purchased the property, I don't see why that wouldn't continue to work in the same way it would on a buy-to-let. Again, to your point way back when we started talking about this, even if the property values decrease, what we know from inflation is that prices still continue to grow. So that would mean staying in properties, that price would remain stable, if not increase itself, the price that you're charging people. Of course, the other element of this that we don't know is about supply. When we're talking about short-term accommodation, holiday lets, it's very much dependent on the amount of supply in your area and whether or not the property you have is more or less appealing than another that they could get in that area. So again, way too many factors for the likes of my small brain to consider.
I think basically you're saying it depends on supply and demand, and we don't know what either of those are going to be like in the future. And it varies by area.
I think we should try and end this podcast while we can possibly get out with any respect intact.
Okay, for the last 30 seconds, I just wanted to mention that after looking at these reports of price increases going up by, I don't know, somewhere between 6 and 10% a year, I did a bit of digging into some of the stats that I collect from or with PATMA. And I was looking specifically at my investment area, so around Redhill. And I was thinking to find out, are these numbers reflected in my area? And what has actually been increasing in price? And generally speaking, yes, Redhill has seen a broadly similar, I think my figures came out at about 6.5%, something like that, increase year on year. And that obviously matches the general sort of picture that we're seeing. However, I looked a bit harder into the stats and I broke them down by the number of bedrooms in a property. And something very specific jumped out. Most of the properties had gone up a little bit, changed a little bit, but where the real growth had happened was in 3-bedroom properties. So what do you think's special about 3-bedroom properties, Stuart? What makes that the area of growth rather than 1 or 2 or 4 or 5?
Was that 3 bedrooms in the Redhill area?
Yes. I don't know about the rest of the country. I haven't looked. But specifically in the Redhill area, the growth in asking prices on properties has really been in 3 bedrooms.
again, without looking at the numbers, but you can just think of all of the, the wider factors going on where people would need to move up to a 3-bed. Because 3 feels to me like that's median, isn't it? In terms of, you're going to start with a flat, like I started in a 1-bed flat.
Yeah, that I think is exactly it. I think 3-bed is generally where sort of the tipping point goes from flat to house. So, I mean, obviously you get 3-bed flats, you get 4-bed flats and more. But generally, I think most flats are studio 1, 2 bedrooms. Houses are 2, 3 plus bedrooms. So that tipping point is where you go from flat to house. I think that's probably what we're seeing reflected in that. The fact that people are wanting a bit more space, wanting that greenery and things, and the things that come with a house.
Phew, did I pass the test?
I think so, yes. And we are out of time, so we need to finish this episode. So I think with that, it just remains for me to say thank you very much for listening. I hope we have said something vaguely interesting to you. Please do get in touch and let us know what you think about the future of the property market and whether you can forecast 5 years out. If you can, that'd be brilliant. We'll pass it on to Chris. Apart from that, you can find show notes and links to all the reports and things we've mentioned on thebusinessofproperty.com. And Stuart and I will talk to you again next week.